The following program is furnished by The Truth About Your Future, LLC. The views expressed do not necessarily reflect the views of this station. This information is education and not financial advice. Sponsors of the program pay a fee to be interviewed. See the truthayf.com disclosure page for details. Consult a financial advisor before investing.
The Truth About Your Future with Rick Edelman is brought to you by Global X ETFs, dedicated to providing investors with unexplored and intelligent solutions. And by Bitwise, a trusted guide in crypto has never mattered more. Connect with their dedicated team of crypto experts nationwide at bitwiseinvestments.com. And by Invesco QQQ, a fund that allows you to access the innovators of the NASDAQ 100, Invesco.com. And by Edelman Financial Engines. Rick Edelman is a board member, consultant, shareholder, and client of EFE, but EFE is unaffiliated and has no say over the content of The Truth About Your Future with Rick Edelman.
This is where technology, innovation, and personal finance come together.
This is The Truth About Your Future with Rick Edelman.
And now your host, Rick Edelman.
I'm Rick Edelman. I'm really glad that you're tuned in to this weekly radio show and podcast, and I've got some big news for you. Starting in January, this weekly radio show is going to become exclusively a daily podcast. I'm really excited about it, but yeah, I have to admit there's a little bit of challenge emotionally for me. I've been doing this radio show for 32 years. It's an award-winning radio show. I've been named by Talkers Magazine as one of the 100 most important radio talk show hosts. I've made that ranking 8 years in a row. And I have to, acknowledge that my radio career has been instrumental in the success of the financial planning and investment management company that Gene and I founded 37 years ago now, Edelman Financial Engines. We started out as Edelman Financial Services. And our whole objective has been the same from day one, which is consumer education, investor education, focusing entirely about the subjects in the field of personal finance that are in your best interest and giving you the advice you need to achieve your financial goals. When we first started out back in the 1980s, there really were no outlets for personal finance education or information. There was Louis Rukeyser, if you can remember who that was, and Money Magazine. That was really about it. Today, of course, there are entire television networks devoted entirely 24/7 to broadcasting about money and investments and Wall Street. There are now thousands of books. I've written 11 of them, thank you very much, and websites galore, all dealing with the subject of money. And our level overall of personal finance knowledge has never been bigger and better. You're participating in your 401k more so than your parents did. You started saving for your future earlier than your parents did, and all that's wonderful. You're more acutely aware of the need to pay attention to your personal finances and dealing with credit and debt and savings and investments, and you're a smart consumer and shopper as a result of all of this. That's wonderful, but there's still so much more to be done, so much information to share. And that's why Gene and I are as committed to financial education today as we have been over the past 3+ decades. But technology is changing as well, and so we're moving along with it, and that's why I'm really excited that you can right now get this radio show as a podcast. Just go to theTruthAYF.com or wherever you download your podcasts at iTunes and Spotify, Apple, Google, wherever, and you can listen to this show at your own convenience. And starting in January, as I said, we're going to take advantage of podcasting technology, and I'm going to start producing a daily show for you. You can subscribe for free right now at your favorite podcasting site or by going to my website at theTruthAYF.com. We're committed to providing you the information you need. That is unchanging, unwavering. Beginning in January, though, I'll be doing it exclusively as a podcast and leaving the radio airwaves for the first time in 32 years. I am incredibly grateful to this radio station and to all of my affiliates for the support that they have provided me and the unique opportunity to share with you the knowledge that I've accumulated in this field. I am indebted to all of those who have been so supportive of our career throughout the decades. We've been in your homes, on your car radios for many, many years. I don't take that lightly. I'm very grateful to you for tuning in on a weekly basis. And we are particularly honored for the unique privilege of being able to be a host on this radio station for more than a decade. And it is an honor that we will remember fondly, and it is an opportunity that we have cherished. And I want to thank you very much for it. And I really hope you'll continue to join us as we continue to record the truth about your future here on the air through the rest of this year, and then exclusively as a podcast beginning in January. It's been a privilege, and I'm going to continue to enjoy being with you on a weekly basis, and very soon, every single day. I'm Rick Edelman. That's my future, and that's what you're listening to, the truth about your future as well. I'm Rick Edelman. You're listening to The Truth About Your Future. What is in store in your future career-wise? What are you doing right now? Are you still working from home, or are you back in the office? Increasingly, big employers are demanding that workers who had been at home working remotely during the pandemic have to go back into the office. But it's still an uncertain situation, very dicey, as employers and employees are trying to figure this out. Are you back in the office at all? Are you there full-time, maybe part-time, a couple of days a week on a sporadic basis? Well, if all of the workers aren't back all of the time, it means that companies are sitting on empty offices, often tens of thousands, hundreds of thousands of square feet of empty offices at a very high expense in rent. It's creating a big problem. In New York City, 20% of offices are vacant. We have thousands of companies that are discovering they now have excess office space. They only have half their staff in the building at any given moment. They therefore need half as much office space as in the past. So a lot of companies stuck with long-term leases are subletting their offices, trying to find others to pick up the tab until their lease expires. It's a real dilemma, and it raises questions. If there's so much empty offices right now, and you happen to be coming along needing office space, you can probably find a bargain. And it's a problem for commercial real estate developers. Why would you want to build a new building when there are so many existing buildings available for someone to lease? What does it mean for the value of commercial real estate? What does it mean for the future value of commercial real estate? Well, in the United States and Canada, pension funds are declaring their viewpoint. They are selling their investments in office buildings, and they're doing it across both countries. They all typically own real estate as part of their diversified portfolios, but what they're doing now, according to Pension and Investments magazine, they're selling their investments in office buildings, and they're buying different kinds of real estate instead. Warehouses, laboratories, houses, airports, and film studios. And by renting out those facilities, they're able to generate income, rental income, and watch the value of those properties rise, they hope. Their attitude is they're more likely to get tenants, they're more likely to get tenants to pay a high rate, and they're more likely to watch these properties rise in value than they'll find in office buildings. So it's a sign of the direction of the commercial real estate marketplace. In North America, pension funds manage about $6 trillion, and they have 9% of it in real estate. This is a very big deal. In Ontario, the Municipal Employees Retirement System is cutting its holdings of office buildings more than 50%. Within their real estate portfolio, almost half of it was office buildings. They're cutting that to 20%. 3 years ago, pensions had 17% of their real estate in retail space, shopping centers and malls. They've cut that from 17% to just 10%, showing that not only are they bearish on office buildings, they're also bearish on retail space, because their attitude is more and more people are shopping online and not so many are going into stores physically. Further illustration how a combination of technology and the pandemic are changing the nature of real estate. and how maybe you need to be reconsidering your investment strategy if you'd like to hold real estate as part of your diversified portfolio. I'm Rick Edelman. We're seeing fundamental changes that are going to last for a decade or more. That's your future.
You're listening to The Truth About Your Future with Rick Edelman. Thanks for listening to today's show, and thanks to Bitwise Asset Management for being our sponsor. Rick asked Bitwise to support the show because Bitwise has just one mission: to help you understand and access the opportunities in crypto. As crypto continues to grow in scale and complexity, a trusted guide is more important than ever. That's why Bitwise has built a nationwide team of crypto experts to help you. So take advantage of Bitwise's team. They work closely with financial advisors, institutions, and individual investors just like you. Talk to a Bitwise expert today or sharpen your crypto knowledge with Bitwise's awesome library of content. You'll find great help whether you're a crypto beginner or a financial professional. Crypto has major risks to consider, including the loss of your entire investment. So before investing in crypto funds, visit bitwiseinvestments.com for their library of content and to learn about the risks with these investments. That's bitwiseinvestments.com.
What do all the greatest innovations have in common? Agents of innovation. Ordinary people who shape the future by putting their money behind the right ideas. Invesco QQQ is a fund that allows you access to innovators of the NASDAQ 100. So you don't have to be an inventor to help create what's next to come. Be an agent of innovation with Invesco QQQ. Learn more at Invesco.com/QQQ. There are risks when investing in ETFs, including possible loss of money. ETFs risks are similar to those of stocks. Investments in the tech sector are subject to greater risk and more volatility than more diversified investments. The NASDAQ 100 index comprises the 100 largest non-financial companies on the NASDAQ. You can't invest directly into an index. Before investing, carefully read and consider fund investment objectives, risks, charges, expenses, and more in the prospectus at Invesco.com. Invesco Distributors, Inc.
When your health diagnosis isn't going according to plan, you likely seek a second opinion. It's time you treat your wealth the same way. Get a new perspective, new information, a new diagnosis for your investments. Get a second opinion from a wealth planner at Edelman Financial Engines. Our dedicated planners offer personalized advice and are ready to talk one-on-one. Our approach is backed by institutional rigor. We model over 38,000 securities monthly, so we can better stress test your portfolio through thousands of scenarios. So, take a deep breath and take care of your wealth like you take care of your health. Get your complimentary wealth checkup today, where you can discuss your financial plan with a wealth planner. Call Edelman Financial Engines at 888-899-4450. That's 888-899-4450. Or visit planefe.com/Rick today.
Let's go to the phones here on The Truth About Your Future. Head off to Columbus, Ohio. Joe is with us on the air. How you doing, Joe?
Very good. How about yourself?
Doing very well, thank you. What can we do to help?
I'm just wondering, give you a little background on what my concerns are. I'm 77. My wife is 68. And we have a portfolio that's approximately 60-40 with 60% equities, maybe 35% fixed, and 2.5% of cash. Sort of. I have a $40,000 6-year annuity that I did years ago to hopefully eliminate the risk. But anyway, we have about $60,000 in cash checking and savings. We have no mortgage, no credit card, no car pay, and we live pretty comfortably on my teacher's pension. I'm a retired teacher.
Mm-hmm. My
concern is, over this last crash of the last 2 or 3 weeks, we've lost over $110,000 or $20,000.
Mm.
Now, at our age, it's very difficult, obviously, to make that up. If we were in our 40s and 50s, obviously, it wouldn't be too much of an issue. But should we be seeing those kinds of swings at our age when there's 2,000 up and 4,000 down and 5,000 up and 3,000 down? What do you think about all of that?
Well, Joe, let me ask you this. Shouldn't you have been asking that question before you built the 60/40 portfolio?
Well, I keep asking that with our advisor, and he keeps saying that we're going to be okay. See, my main concern is when I retired from teaching, our previous advisor told me to take the half-life annuity because, we would have tons of money for the future. Well, obviously that didn't happen.
Well, the half-life annuity, what is the amount of your monthly pension?
$3,400 and change.
Which means when you pass away, your wife will get $1,700 a month.
Correct. Plus a little bit, about $300 in Social Security right now.
So can your wife live on $2,000 a month?
Probably not.
Then the half-life annuity was not a great idea. It sounds like the advisors that you've been dealing with have not been all that fabulous. How many years has your current advisor been an advisor?
I'd say about 9 years.
Okay. Well, the problem is that over the past 8 or 9 years, the stock market, the bond market, the real estate market have all been doing fabulous. So has the crypto market. And if your advisor's total experience is just the last 8 or 9 years, and they don't have a lot of training in longer term economic history, meaning they don't understand what happened in the 1970s or the 1950s or the 1930s, let alone we go back to a great number of periods throughout American history, for example, the 1860s and 1870s, then they could have a Pollyanna perspective. It's been rather casual and rather cavalier for people to say, oh, market decline, don't worry about it, sit tight, it'll come back, because it pretty rapidly has done that every year for the past 10 years. But if we go back to 2007, 2008, which predates your advisor's experience, we had 3 years of severe declines that you will remember. If we go back to 2001, the dot-com bubble and 9/11, it was a horrific period of time. If we go back to 1992 with the major recession that we had at that period, or of course the 1970s, I'm not so sure that a person who lived through all of those would take a cavalier attitude of, oh, just sit tight, 60/40 will be fine and you'll do okay. I think that it does make sense to reevaluate the level of risks that you're taking. The bond market is totally different than what it's been for the past 42 years. If we go back to 1980, the interest rates were very high. Did you own a home back in 1980?
Yeah, we purchased in 75, and we thought we were getting a great deal at 8%.
An 8% mortgage in 1975. And you remember what happened by 1980 where mortgage rates were. They were 15, 18%. So we now have seen those interest rates drop from 18% in 1980, dropping all the way down where mortgage rates were 2.5% a year ago. This was a 42-year period of declining interest rates, a generational occasion. And people, in other words, who have spent their adult lives over the past 42 years experience nothing but declining interest rates. And that means rising bond prices, because when interest rates go down, the value of bonds goes up. And that has been very exciting for the past 42 years. But now look where we are. We're now at the bottom of that valley where interest rates are at their very lowest. And now for the past couple of months, interest rates have started to go up. And as interest rates go up, bond prices fall. So you have to ask yourself, what can I reasonably expect from interest rates over the next several years, the rest of this decade? Are interest rates going to keep going up? Can we reasonably expect them to go back down to where they were? Because that's what would have to happen for your bond prices to recover. So I'm not so sure that I feel comfortable at all about owning long-term bonds. I don't own any. I don't recommend the bond market at all right now. I don't think it makes any sense because we are in a rising interest rate environment. We've seen severe losses in the bond market. I think those are going to continue. And I think it's Pollyanna to suggest, oh, just hang in there and it'll all work out. If you own mutual funds of bonds or ETFs of bonds, I'm not so sure that is the right strategy. We also have to look at the stock market, because we have severe pressures going on right now, and we are in the middle of a bear market at the moment. We have a recession on the horizon. So you have to put all of this into proper perspective to ask yourself, why am I invested in the first place? The reason you've been doing what you've been doing for the past 50 years is that you've been accumulating assets, building wealth to support yourself in your retirement. And you've done a great job of it. You've amassed $430,000 in investments, $60,000 in cash. Your home is fully paid for. You've got money in an annuity and a pension. You're doing fabulous. But what that means is, Joe, you've been spending your entire life climbing the mountain. Well, you've now reached the top of the mountain. It's time to stop climbing. If you try to keep climbing, you'll fall off the other side. So we need to recognize it's now time to protect and preserve the money that we've got. We don't need to double it anymore. We don't need to triple it. That's not going to change your lifestyle. But if you lose half of it, that could create financial jeopardy for you and your wife. So I think what you need to do is reevaluate what you're doing with your financial advisor. If you're not satisfied with the answers that you're getting, talk to other advisors, get other opinions, and see what they may have to offer you in terms of advice for your situation now, given the economic environment that we're in.
See, that was my concern, that from 2008 to right now, that was 14 years to get us to 530. We don't have 14 more years to get that $110,000 back. So that's the direction I want to go, to try to, just like what you said, is to protect and not so worry so much about trying to accumulate more wealth, which would be nice, but.
So I'd recommend that you talk with a financial advisor. Of course, I created Edelman Financial Engines 37 years ago, the largest financial planning firm in the country, with advisors all around the U.S. Talking with them would be a good idea for you. You can reach them at edelmanfinancialengines.com. And I would encourage you to talk with another financial advisor or two, get second, third opinions, and contrast that to the advice that you've been receiving to date so you can figure out what makes sense for your situation.
Listen, I appreciate your help and your conversation, and thanks so much again for everything you've talked about.
It's my pleasure. I really enjoyed the phone call, Joe, and I wish you and your wife the very best. That was Joe in Columbus, Ohio, here on The Truth About Your Future. You can do what Joe did. Send me your question to AskRick@thetruthayf.com.
The Truth About Your Future is sponsored by Global X ETFs. You tune in every week to hear Rick Edelman tackle the personal finance topics that matter most to investors. And this year, what matters most is market volatility, stubbornly high inflation, and rising interest rates. It's been a lot to grapple with. At Global X ETFs, our income-oriented strategies can be an appealing way to help you position your portfolio during this period of uncertainty and volatility. Our approach goes beyond bonds and traditional fixed income investments. We focus instead on asset classes that offer you income-producing potential that you may not have considered, including MLPs from the energy sector, real estate investment trusts, preferred stocks, covered call strategies, and dividend-paying stocks. We've been providing investors like you with income-oriented investments like these for more than a decade through both bull and bear markets. Come, explore our full range of ETFs and look at our research and more at globalxetfs.com or talk with your financial advisor. Global X ETFs.
The Truth About Your Future with Rick Edelman is sponsored by Charles Schwab. Schwab's passion for serving clients is more than standard practice. It's part of who they are. With transparent pricing, 24/7 live support, and a satisfaction guarantee, the people at Schwab go the extra mile to help you on your investing journey. They're not just financial people, they're people too. Learn more at schwab.com/whyschwab. That's schwab.com/whyschwab.
You're listening to The Truth About Your Future with Rick Edelman, sponsored by Choice. If you want more control over how you invest your money, you need to check out Choice. Choice makes it easy for you to invest in Bitcoin and other crypto assets in your retirement account. You can transfer your existing IRA, roll over an old 401k, or start fresh with a new investment. There are no hidden fees or account minimums, just more choice in how you invest your money. You can open a deductible or Roth IRA and invest in Bitcoin, crypto, stocks, ETFs, gold, real estate, and more, all in a single account. Don't let your old bank or brokerage firm limit what you're allowed to invest in. Do what Rick did and take control of your future by heading on over to retirewithchoice.com/Rick. That's retirewithchoice.com/Rick, or simply search Choice IRA in the App Store or Google Play Store on your iPhone or Android device. It's your money. It should be your choice. retirewithchoice.com/Rick.
You're listening to The Truth About Your Future. I'd always like to bring on some really impressive guests onto the show to help you get the most out of your money and making sure you're making the right investment decisions and managing your portfolio correctly. So I'm really excited to bring on these two very high quality executives and very renowned gentlemen in the field of personal finance. First, John Frank. He's the head of ETF Specialists for Invesco, and Nick Kalivas, who is the head of factor and core equity product strategy at Invesco as well. You see both of these folks quoted in the trade press all the time. They're quoted in the Wall Street Journal and at Barron's, the New York Times. They're on CNBC, and they deal with institutional clients as well as high net worth clients. John, let me start off with you, and thanks for joining me on the show. You know, when folks think I'm talking to people from Wall Street, especially investment managers and strategists such as yourself, people think that we're going to be talking about investments. But what's equally important are the taxes on their investments. And people tend to think about taxes little, if ever, right, when they're looking at their investments.
That's so true. I think the thing about taxes is, first of all, they're unavoidable, but they nibble away here and there. And what really happens is, most investors think about not just in 1 year terms, but 5, 10, 15, 20 year plus terms. And those little nibbles can really have a large impact over long periods of time. So, and it's one thing too that is very much in our control. Some of the things we talk about is control what you can control and get educated. So when it comes to taxes, understand what's in your control and be educated to understand the impacts of the actions you take, what it might have on your portfolio, not only in the short term, but certainly over the long term. Because for investors, they know the compounding can take it. That compounds of returns can have a large impact over periods of time. So when you think about just the same way of taxes, a little bit of compounding on the negative side, even though it could be small, over long periods of time, that can have quite an impact on the portfolio.
Yeah, I think you said it really well. We can't control what the markets are going to do tomorrow, but we can certainly control when we're going to sell, and the date we sell has a big impact on the tax rate we're going to have to pay. And we've got to remember that it's not what we earn that matters, it's what we keep net of tax. So I think you're absolutely right. So drill into that for us, John. What do people need to be thinking about when it comes to managing their taxes related to their investments?
So I think it really comes down, for us, we think about two main things as it relates to taxes. First is tax loss harvesting, and that's about controlling what you sell, when you sell it. And I think it's also about taking advantage of a poor situation. So no one likes to have negative returns, but think of it as really the negative return can actually have an impact on the portfolio, and taking advantage of that negative return to minimize the taxes you pay in the current period is one way to do that.
So that's really a huge thing. In fact, what you just highlighted is that we have finally found a way to be happy about the fact that the stock market has done so poorly this year. Because for you to take advantage of tax loss harvesting, you have to have losses in the account. And for the past decade, really, there really haven't been losses. The market's been continually rising. This year, the stock market's down 20%. And this creates the opportunity to turn lemons into lemonade. So explain how tax loss harvesting works.
So tax loss harvesting really is about taking advantage of the losses you have in an investment portfolio or in a single investment. So think about it. If you purchase an investment, let's say for $10,000, and it goes down by 20%, which unfortunately is not too atypical in the last 18 months. So now that $10,000 investment is worth about $8,000. What you can do by harvesting the loss, we talk about harvesting the loss means you got to sell the investment at $8,000. So then you're able to book a $2,000 loss, and that's what we call the harvesting. And then the next part is you do want to maintain exposure. We assume that that investment was doing something in your portfolio, so you replace it with not the exact same thing, and it can't be exactly the same, and it can't be substantially the same, as defined by the IRS. And what you do is you're able to take that $2,000 loss, you replace it with something else. But now when it comes to filing your taxes, you can take that loss and you can attribute it to something that has gained money in the portfolio. You can also use it against a capital gain distribution, which could be coming, or in some cases, you can actually take that $2,000 loss and deduct it against your ordinary income. And the IRS allows you to maximize that at about $3,000 per year. But there's many ways you can use that $2,000 loss to have a positive impact in the current year for your taxes paid.
So this is a really wonderful opportunity that as we approach the end of the year, people need to really be thinking about. This is a way for you to make the most of a lousy year, that although you've got losses in the account, you can lower your tax bill as a result of this. So if you haven't considered tax loss harvesting, you really need to talk to your financial advisor, you need to talk to your tax advisor, and do it before the end of the year so that you can capture it for 2021. But that's not the only way that people can improve their investments, John, by paying attention to taxes. There are some ETFs on the market that are better at lowering your taxes than others. Talk about that.
One of the big areas that people do not understand about ETFs is I think they think all ETFs are the same and very different than mutual funds. I think on the surface, ETFs and mutual funds are maybe more similar than people understand. At the end of the day, both are striving to provide a diversified account that has many different stocks or different types of securities in it. So you don't have to be the portfolio manager and think about when to buy what each individual security. But the big difference for ETFs, and we really think about ETFs as a different technology to accomplish the same goal that mutual funds go after, is that they're exchange traded. And one of the advantages of being an exchange traded fund is our portfolio managers interact with what is called APs, or authorized participants. So at the end of the day, instead of buying and selling in the marketplace, they're actually able to do what they call an in-kind transaction. So rather than selling a stock, they deliver the stock to the AP, and the AP delivers shares back to them. At the end of the day, that's not considered a taxable event by the IRS. On the flip side, when you think about a different type of vehicle like a mutual fund, the portfolio manager on mutual funds is actually making transactions in the market. They are buying and selling securities on behalf of the fund, directly for the fund. And as a result of buying and selling securities, you will actually get a potential capital gain in that portfolio or a capital loss. And what happens at the end of the year is that those gains and losses are distributed to investors. So you could be an investor in a fund and not have done anything at all. You've held it all year long, but since the portfolio manager has been making those trades on your behalf, you actually get assigned the capital gain at the end of the year and owe taxes on it. Whereas on an ETF, you see the portfolio managers using that in-kind mechanism, which allows them to minimize the capital gains. And I think one stat that points to, for understanding what's an AP do and what's going on. But at the end of the day, when we looked at last year, about 78% of mutual funds paid a capital gain versus ETFs, 7% of US equity ETFs paid a capital gain. And then when we look at the amount of the gain, it's quite staggering as well. So large cap blend mutual funds last year paid an average capital gain of 9.0%. So that means if you had a $100 investment at the end of the year, about $9 came back to you via the form of capital gains, which you'd owe taxes on. On the ETF, that's instead of 9%, it was 0.6%. So ETFs don't necessarily always, they can't get rid of capital gains, but they do a great job of minimizing it. So 0.6%, obviously much less than 9.0%. And as an investor, that just means your tax bill that year is lower, and the amount of taxes you owe the government for that year is minimized.
And that is like an incredibly powerful thing. If you can drop your tax bill by so much merely by owning a tax efficient ETF. And that's one of the big claims to fame that Invesco offers, which is why Invesco is one of the largest ETF providers in the country. So you've really got to look at your portfolio. Do you get annual capital gain distributions? December's coming up. This has been a very volatile year. Fund managers have been doing an awful lot of trading, trying to minimize the damage from the decline, capturing the upside that occurred in the summertime, and it's creating a lot of churn. And in an ordinary mutual fund, as John has just expressed, that's going to create a massive tax liability for you at the end of the year if you're in an ordinary taxable mutual fund. But if you're in a tax-efficient ETF, you'll avoid all of that. So you really need to make sure you're using tax-efficient investments, and I strongly encourage you to talk to your financial advisor about Invesco ETFs for exactly that reason. John, I really appreciate that explanation you've provided. It made a lot of sense. Nick, let me shift over to you. One of the big reasons that we mentioned ETFs are so popular is because they're so much more tax efficient. But at the same time, there's another thing going on. Mutual funds are typically managed by a fund manager. They're trying to pick stocks that are going to grow faster than other stocks. You know, they're trying to beat the overall market. You contrast that to ETFs. They're typically tracking an index. They're not trying to beat the market. Their approach is a different way of doing business. Talk about which of these two approaches you think is better.
Yeah, well, it really boils down to a choice, but I'm going to be biased because I'm in the ETF business, and kind of spend my my days and my work life very dedicated to the ETF. And let me try to shed some light on some of the similarities between active managers and ETFs. And I think the efficiency of the ETF wrapper, the transparency of the ETF wrapper, the lower cost efficiency, those things all, I think, give some edge to the ETF in terms of gaining exposure. Now, when you think about active managers, they use strategies or stock selection methodologies in their investment process. You know, they have mandates that they use. You know, you can think of an active manager being focused on value or growth in income. You know, you pick the category, but they have a mandate. When you get into ETFs, and especially the Invesco lineup, which is focused on what I would say smart indexing or factor-based indexing, those ETFs are using some of the exact same strategies that active managers use. They are ETFs, they're strategies in the ETF based on underlying indexes that screen for stocks or screen for stocks in a stated strategy, say, value or growth, and they reconstitute, they rebalance periodically to maintain that exposure and avoid drift. The ETF process is very systematic. It's very rules-based. It's transparent. They just have removed the human element to that. And let me give you maybe an example. Here at Invesco, we have a S&P 500 GARP ETF. The ticker on that is SPGP. So it takes the S&P 500 and it screens for the 150 stocks that have the fastest earnings and sales growth over the last 3 years. So, that's something an active manager might try to do. Once it has that pool, it then picks the 75 with the lowest valuation, so the cheapest stocks, and the highest quality characteristics, and it weights them by their growth score, and it repeats that process twice a year. And so I think that gives you a feeling here that the ETF can be very, dynamic and strategic in the selection process. Moreover, these indexes that drive the ETF, there is an index provider behind them, and they provide a lot of information and back-tested history. So if you want to do due diligence, you can see how the strategy performed in different market environments, different regimes. You kind of know how the strategy is going to act because it's systematic and rules-based. With a human, you just don't know. They could react differently to different environments, and I think that's helpful in terms of the construction process. And I would say, lastly here, you can analyze active strategies for their exposures. There's software programs out there, there's analytics out there where you can do an X-ray into the manager, and you can identify kind of what their strategy is. Are they value? Are they growth? Are they value? Momentum and quality. You can pick that kind of strategy, and typically you can replicate that strategy through a grouping of ETFs or a single ETF wrapper there. So really, the ETF, the smart ETF, goes a long way towards doing what active management can do, but doing it in a more tax efficient and probably cost efficient way.
And that's one of the big differences between the two that I think a lot of investors don't realize. I think you said it at the top that most people think all ETFs are the same. And in fact, ETFs are as diverse in what they do, how they operate as the rest of the stock market. But as you pointed out, they do it more efficiently and they do it more cost effectively. So I think it really argues for people to look beyond the brand, look beyond the name. Don't judge a book by its cover, and take a look at exactly how is this ETF constructed and what are the rules that are governing its trading. And I think you'll discover that when you do that behind the curtain examination, you might not be as impressed with your mutual funds as you thought you ought to be. And this is a wonderful opportunity, especially in today's volatile marketplace, to reevaluate the investments you're holding to see if they are properly positioned for the kind of environment we are finding ourselves in today and what is likely to be coming for years to come. And that's why you should take a real serious look at the Invesco ETFs, because I think you'll find a unique set of ETF opportunities that you may not be all that familiar with. And in fact, one of those, Nick, is something that we're starting to, at least I'm starting to see more and more conversation about this in the marketplace. But I think most investors, most people listening to this show are not really familiar with. They're called factor ETFs. Talk about what they are and how they work.
Yeah, sure. So factors is a very kind of esoteric term that is kind of emanated from academic circles where there's a lot of research on investment done. But despite it being kind of a funny term, it's actually very simple and straightforward. It's just grouping stocks by similar qualities or characteristics. And one way I like to explain it is if you just kind of think about the S&P 500. So you can think about all the stocks in the S&P 500, that parent universe. We'll start grouping the stocks in the S&P 500 by similar characteristics or qualities. So for example, if we take the 100 stocks with the lowest standard deviation of return or lowest volatility, when we put them in a bucket or a portfolio, that's your low volatility factor. You can go the opposite end of the extreme. You could think about the 100 stocks with the highest beta or higher risk. You can put them in a portfolio, and that becomes your high beta, your high risk portfolio. You can do the same if you think about, what are the 100 cheapest stocks? That becomes your value portfolio, or the stocks that have the fastest earnings and sales growth. That can become your growth portfolio. So you just start dicing and splicing a universe of stocks into, portfolios of similar characteristics. And what is interesting is that these factors, these different groupings, have differentiated return and risk characteristics relative to the broader market itself, like the S&P 500 or Russell 1000, or actually compared to each other. So low volatility acts different than momentum or different than value. And so it really, I think, creates the situation where factors can provide what some people call the DNA of a portfolio, or the ingredients of a portfolio, or the pillars of the portfolio. And you can use them to kind of raise your return, lower your risk, diversify your portfolio too. And really the ETF wrapper is very good for that, because factor strategies have turnover, because they are, systematically trying to capture those stocks with a certain characteristic or trait. And so periodically, the ones that don't meet that criteria are going to get kicked out, and the ones that do are going to be put in. And so you can generate a lot of turnover. And as John mentioned, the redemption and creation process helps to shield the investor from a capital gains perspective.
You know, I've spent time at Invesco's website, and you have a very broad array of ETF opportunities. And it's fascinating as you go through them. It's fun process to see how different you can construct portfolios, how you can alter your emphasis on the kinds of stocks that you want to invest in. And Invesco has a lot of tools and information on its site that makes it really easy. And you can also, of course, talk to folks at Invesco who can help you identify where your levels of interest are, what you find of greatest value, what you consider to be the direction you want to emphasize in your portfolio. And Invesco makes this really easy through its broad array of ETF options. And you should also talk with your financial advisor, if you have one, about this as well. This is not a one-size-fits-all environment anymore in the stock market. And there are only a few fund companies that make this wide array available to you. And I think you do yourself a favor by looking at Invesco, and you'll quickly begin to understand why they're one of the oldest and biggest ETF providers in the country. That is John Frank, the head of ETF Specialists at Invesco, and Nick Kalivas, the head of Factor and Core Equity Product Strategy at Invesco, here on The Truth About Your Future. John and Nick, thanks so much for joining me on the show.
Thanks for having us, Rick.
Yep.
Stay with us for more here on The Truth About Your Future.
Allow us to introduce you to Sabrina, an ordinary person who helped shape the future by putting her money behind the right ideas. Each morning, Sabrina enjoys a 20-mile bike ride and meditation that brings her serenity for the day to come. Sabrina is also accessing the companies that are revolutionizing the tech world by investing in Invesco QQQ. Invesco QQQ is a fund that allows you access to innovators of the NASDAQ 100, which goes to show you don't have to be an integrated circuit engineer to help push progress forward. Become an agent of innovation. Learn more at Invesco.com/QQQ. There are risks when investing in ETFs, including possible loss of money. ETFs risks are similar to those of stocks. Investments in the tech sector are subject to greater risk and more volatility than more diversified investments. The NASDAQ 100 index comprises the 100 largest non-financial companies on the NASDAQ. You can't invest directly into an index. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Visit Invesco.com for a prospectus with this information. Read it carefully before investing.
Afraid to look at your financial statements? Shredding them without opening them? It's time for a second opinion from Edelman Financial Engines. Our opinions aren't based on intuition or daily market movements. They're grounded in institutional rigor, and all of our planners are fiduciaries who put your interest above all others. So if you need help managing the ups and downs of this market, we're ready to talk. At Edelman Financial Engines, you get personalized investment recommendations from a dedicated wealth planner who doesn't sell products to earn commissions. So stop shredding those financial statements. Let's take a look together. It's time to get a second opinion. Get your complimentary wealth checkup where you can discuss your financial goals with a wealth planner. Call Edelman Financial Engines at 888-899-4450. That's 888-899-4450. Or visit planefe.com/Rick today.
The Truth About Your Future is sponsored by Global X ETFs. You tune in every week to hear Rick Edelman tackle the personal finance topics that matter most to investors. And this year, what matters most is market volatility, stubbornly high inflation, and rising interest rates. It's been a lot to grapple with. At Global X ETFs, our income-oriented strategies can be an appealing way to help you position your portfolio during this period of uncertainty and volatility. Our approach goes beyond bonds and traditional fixed income investments. We focus instead on asset classes that offer you income-producing potential that you may not have considered, including MLPs from the energy sector, real estate investment trusts, preferred stocks, covered call strategies, and dividend-paying stocks. We've been providing investors like you with income-oriented investments like these for more than a decade through both bull and bear markets. Come, explore our full range of ETFs and look at our research and more at globalxetfs.com or talk with your financial advisor. Global X ETFs.
listening to The Truth About Your Future. Let me ask you a question. Who makes more money? People who are on the political left or people who are on the political right? Who makes more money? Racists or inclusionists? Well, there's a new survey called the British Social Attitudes Survey. They've been doing this survey for decades. 30 years ago, when they conducted this survey, they discovered that economically, there was no difference between politically liberal people and politically conservative people. Liberals and conservatives made pretty much the same amount of money. That was 30 years ago. Today, they've just released the new annual survey. Racists now earn 1/3 less than those who have more liberal views on race. And conservatives earn half of what liberals earn. Those who support the death penalty earn half as much as those who oppose the death penalty. And their results in Great Britain are the same in the United States. In 1990, white conservatives earned the same amount of income as white liberals, but today they don't. And here's one theory that the researchers are offering for this. The way people feel is ingrained long before they graduate from high school. We develop our attitudes about most things in life when we're children, based on our communities and, of course, no short shrift, our parents and often our religious upbringing. Those with conservative views are less likely to go to college. And college is the key to high-paying careers. According to one study, 66% of liberals, 2/3 of them, have a college degree, but only 14% of conservatives do. So is it possible that people who are growing up politically conservative don't want to go to those liberal colleges, because most colleges are liberal, and they therefore choose not to go to college? And by not going to college, they're denying themselves the economic opportunities that having a college degree provides. And the result is a huge and growing difference in incomes and net worths of liberals versus conservatives. You could also argue that the lack of a college degree creates a bigger division in knowledge, not merely incomes and attitudes. It's a fascinating aspect on further areas of division within our country. And apparently it's not limited to the U.S. because they're finding the same issue in Great Britain. I'm Rick Edelman, and you have to wonder what this means for our future. Time now for everybody's favorite segment of the program, a visit by my wife, Jean Edelman. Jean, a student of the healing arts, Reiki, traditional Chinese medicine, homeopathy, acupuncture, and of course, macrobiotic and plant-based cooking. Here's Jean.
Great to be with you this week. This week, a curious word was popping up. The word is witness, to observe and to be present. We all watch our detective shows where it's all about the witness to prove the case. Well, what if we turned our eye onto ourselves where we witness our life? When we witness, we can take a step back and see what's happening without the emotions or the drama attached to the event. This is a wonderful tool for our emotional toolbox, because when we're stressed and overwhelmed, it is much healthier to step back and be witness of what's going on so that we can learn from the experience and not get drawn into the emotion and the drama that's unfolding. A lot of people are out there just to push our buttons and see how we're going to react. And so when we step back and we witness, we are going to surprise them. It is so much healthier if we can witness our feelings without them defining us or without them sticking to us. We have a choice about how we feel and how we wish to continue on, how we wish to deal with the situation. And I would bet that we would prefer not to be frustrated and upset. But the way to do that is to witness, to step back, not let others push our buttons or trigger us. And so short and sweet this week, the word of the week is witness. W is for wonder. What would it be like to have a day of calm and peace? A day of not getting upset or stressed? That could be Alice in Wonderland. I don't know. It would be a wonderful goal. It is a goal of mine. I don't know if I've accomplished it yet, but it is something that I wish for all of us in the world. But if we could practice stepping back and letting go, we might have a better day. Just being mindful, just pay attention and see when and where we can do that. When and where. The I is for insight. If we were to practice stepping back and witnessing, we would gain tremendous wisdom and insight to our life and insight to ourselves, an insight to what's important, and all those triggers and all those buttons. We would see them coming and we wouldn't let them get pushed. And so insight is so important. The T is for tame. Because if and when we have those buttons pushed, we really, really need a way to tame that down, to not engage. It really doesn't do anyone any good to get engaged and all worked up. It's better to kill with kindness. We would get a lot more accomplished in this world. The N is for nice. Just be nice. Put ourselves in others' shoes. They're probably going through something pretty big. And so if we just stop and witness, take some breaths, and maybe be a little bit compassionate and empathetic towards them, maybe we could help them. And being nice to ourselves. Just give ourselves a break. It always doesn't have to be so perfect and so whatever it is that we're trying to accomplish. Just be nice. The E is for empathy, to care and have compassion and understanding more for ourselves. We are very hard on ourselves. We don't need to dive into the drama. And again, the healthiest thing is to step back and witness what's going on. The S is for save, to save ourselves for what's really important. We need to let the little stuff go because you know what? It is little stuff and it won't matter eventually. We think it matters now, but it really won't matter down the road. And so just figure out what's important and save ourselves and save our energy for what we want to put ourselves into. And the last S is for serene, being composed and unruffled. Like I said, most of life is a test, and how we react to what's going on around us, that's our grading point. And so if we get to know ourselves better and what sets us off, we can understand what's happening and remain composed and unruffled. Never let a situation or someone get the better of us, because then they have gotten the better of us and they won. And if we can step back and smile and show compassion, well, then we've won. It's always a test, and the goal is to pass with flying colors. Have a great week, everybody.
I know you can't get enough of Gene. Well, you can go to thetruthayf.com for more of Gene's Words of the Week.
Did you know Schwab offers a satisfaction guarantee? If for any reason you're not completely satisfied, Schwab will refund your fee or commission and work with you to make things right. You won't find that kind of promise everywhere, but you will find it at Schwab. It's just another way that they put clients' interest at the heart of everything they do. Learn what's included and how it works at schwab.com/satisfaction. That's schwab.com/satisfaction.
You're listening to The Truth About Your Future with Rick Edelman. Thanks for listening to today's show. And thanks to Bitwise Asset Management for being our sponsor. Rick asked Bitwise to support the show because Bitwise has just one mission: to help you understand and access the opportunities in crypto. As crypto continues to grow in scale and complexity, a trusted guide is more important than ever. That's why Bitwise has built a nationwide team of crypto experts to help you. So take advantage of Bitwise's team. They work closely with financial advisors, institutions, and individual investors just like you. Talk to a Bitwise expert today or sharpen your crypto knowledge with Bitwise's awesome library of content. You'll find great help whether you're a crypto beginner or a financial professional. Crypto has major risks to consider, including the loss of your entire investment. So before investing in crypto funds, visit bitwiseinvestments.com for their library of content and to learn about the risks with these investments. That's bitwiseinvestments.com.
Hi, Rick Edelman here. Join me for my new master class, Preparing Teens for Their Future: How to Prevent College from Ruining Their Lives. It's free, it's online, and it's premiering this month. Sign up today for free at thetruthayf.com.
Bye-bye.
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 I'm sorry, what? What part didn't you understand? The buh or the bye? Bye-bye.
The Truth About Your Future with Rick Edelman has been brought to you by Global X ETFs, dedicated to providing investors with unexplored and intelligent solutions. And by Bitwise, a trusted guide in crypto has never mattered more. Connect with their dedicated team of crypto experts nationwide at bitwiseinvestments.com. And by Invesco QQQ, a fund that allows you to access the innovators of the NASDAQ 100. Invesco.com. Stay tuned for Everyday Wealth with Soledad O'Brien and Gene Chatsky from Edelman Financial Engines. Everydaywealth.com/radio. EFE and The Truth About Your Future with Rick Edelman are unaffiliated entities.
Get the truth about your future every weekend with Rick Edelman. It's thetruthayf.com.